Imagine trusting a digital vault with everything you own, your savings, your future, then one morning you log in, and it's all gone. This isn't a scene from a movie. This is the story of FTX, a man once hailed as the hero of crypto and an empire worth billions that vanished almost overnight. How did the poster boy of the new financial era become the symbol of a historic collapse? And what does his story teach us about trusting the promise of a crypto revolution? In just a few short years, FTX exploded onto the scene. Founded in 2019 by a math whiz from MIT named Sam Bankman-Fried, it quickly became one of the world's largest cryptocurrency exchanges. SBF, as he was known, was a former trader at the prestigious firm Jane Street, and he found himself at the helm of a crypto empire seemingly overnight. The vision was grand. This was the new frontier of finance: borderless money, digital tokens, the promise of financial freedom for all. And at the heart of it was FTX, planting its flag in this new world. Bankman-Fried wasn't just selling a product. He was selling a philosophy. He championed effective altruism, the idea of earning to give. He portrayed FTX as a crypto company that could change the world for the better. But real-world systems don't run on ideals alone. At its peak, FTX was valued at a staggering $32 billion. And then, in less than a year, it all unraveled. It was like watching Icarus fly too close to the sun, his wings built not of wax and feathers but of hype and leverage. To understand how it all came crashing down, we first need to understand how the system was supposed to work. It starts with the basic exchange model. You, the user, deposit your money or crypto into FTX. You can then trade, invest, or even speculate on different digital assets. The fundamental promise, the bedrock of the entire operation, was this: we hold your assets safely. You can trade freely. Trust was the ultimate currency. You had to believe that your money was secure and that you could withdraw it at any moment. But FTX wasn't just an exchange. It had a sibling company, Alameda Research, a trading firm also founded by Bankman-Fried. Alameda's job was to trade, make big bets in the crypto market, and it held a significant amount of FTX's own cryptocurrency token, FTT. This is where things started to get complicated. Think of it like a casino built inside a glass dome. The gamblers inside believe the house has the cash to pay out their winnings. But behind the curtain, the casino's owner is taking all the cash from the vault and making his own wild high-risk bets in a different game. That's essentially what happened. Customer deposits on FTX, which should have been kept completely separate and safe, were reportedly being funneled to Alameda. This sister firm then used those funds to make massive, risky investments and cover its own losses. Post-collapse investigations revealed that up to $9 billion of customer funds were simply missing. The system was a house of cards. The user trusted the exchange. The exchange was supposed to hold the funds. But instead, a linked firm, Alameda, borrowed those funds to make high-risk bets. And a key part of this whole structure was FTX's own token, FTT. Alameda held huge amounts of it. So when the token's value started to wobble, the entire house of cards began to shake. Let's use another metaphor. Imagine a huge lake filled with customer funds. This lake feeds a dam, which is FTX. But behind the dam, there's a secret gambling den, Alameda, siphoning off water from the lake to fund its operations. When a crack appears in the dam, the water rushes out and everyone realizes the lake is nearly empty. It was a system built on high speed, high stakes, and dangerously low oversight. The turning point came in November 2022. Binance, the world's largest crypto exchange and an early investor in FTX, announced it would be selling its massive holdings of the FTT token. This single announcement was the spark that lit the fuse. It triggered a catastrophic loss of confidence. In just 72 hours, FTX was hit with billions of dollars in withdrawal requests. It was a classic bank run. But in the unregulated world of crypto, everyone rushed for the exit at once. Unlike a regulated bank, FTX had no federal insurance and lacked the transparency to prove it could meet the redemptions. The illusion shattered. On November 11, 2022, FTX filed for bankruptcy. Sam Bankman-Fried resigned. The new CEO, brought in to clean up the mess, said something utterly damning in the bankruptcy filings. He wrote, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. In that moment of collapse, billions of dollars vanished into thin air." The overnight giant became a cautionary tale. The man once celebrated for his plans to give away his fortune, now faced accusations of stealing fortunes from others. So what exactly happened in that final crisis? The FTT token's value collapsed, triggering margin calls for Alameda. Alameda, it turned out, was insolvent, loaded up with its own token and other illiquid bets. FTX simply didn't have the real funds to cover the flood of user withdrawals. Public confidence evaporated, and the game was over. It was the moment the grand illusion collided with brutal mathematical reality. The aftermath was enormous. The ripple effects spread far and wide. The entire crypto market lost billions in value as fear spread. Regulators and governments around the world pounced, pointing to FTX as definitive proof that the crypto sector lacked transparency, oversight, and basic consumer protection. Countless retail investors, people who had put their life savings into the platform, were burned. Major venture funds had to write off their multi-million-dollar investments. The trust that the industry had worked so hard to build was severely damaged. This wasn't just a crypto story. It was a massive alarm bell for corporate governance. It exposed how a single charismatic founder, a loosely controlled empire, and opaque financial dealings could bring down a company that, on the surface, looked wildly successful. The broader lesson applies far beyond crypto. FTX fall is a metaphor for any fast up, faster down venture. Whether in tech finance or any new frontier, the promise of disruption is exciting, but the risk of collapse is just as real when rules and controls are ignored. For you and me, the message is clear. If you're putting your money, your trust, or your belief into a system that screams, "We are the future," you have to ask yourself some hard questions. Who is watching the watchers? Who pays the price when it all goes wrong? The relevance today is stark. As crypto continues its push for mainstream adoption, the story of FTX is a warning carved in real time. Hype plus weak oversight equals extreme vulnerability. So, what are the key takeaways from this financial disaster? First, trust is not enough. Transparency is what matters. The people who used FTX had to believe their assets were safe. The reality behind the scenes was a world away from that belief. We need to be able to verify, not just trust. Second, innovation without governance is a time bomb. You can move fast and break things, as the Silicon Valley mantra goes. But at some point, the things you break can break you. The bill always comes due. Third, we saw how power and money can concentrate, creating a fragile system. Sam Bankman-Fried built an empire centered on risk and scale. But that very scale, combined with a lack of controls, became the seed of its own destruction. Fourth, the future of finance, no matter what form it takes, demands accountability. Whether it's crypto, fintech, or old-school banking, if something sounds too good to be true, it probably is. The most unsettling truth? The next FTX might not have the same name or logo, but the same dangerous mechanics could be hiding behind another revolutionary idea. When money flows without borders and promises of disruption replace real protections, the stakes become global. Let this story serve as more than just a crypto scandal. It's a lesson that even the most magical seeming carpets have to land eventually. The real question is, what will you trust next? And more importantly, what will you demand in return for that trust? I want to know what you think. What system are you trusting with your future? And how safe do you think its foundation really is? Do you believe financial innovation can ever be truly safe without strong oversight? Drop your thoughts in the comments below. Let's start a conversation. Thanks for watching, and don't forget to like and subscribe for more deep dives at